Hey everyone, you're watching my daily trade log and I have a fantastic news for you. My trade from yesterday was an absolute winner. It produced over 10,000% return annualized and it was an IBM calendar trade. I sold the January 27, so expiring this week, $35 put option, and I purchased the April $35 put option, and the deal cost me $3.61, and I was able to close this trade at $4.64. So that's a tremendous over 10,000% annualized return. So how did it work? Why did it produce such a great return? Now, this diagram should show you the mechanics of calendar spreads around earnings. So as you can see, the bottom line is showing my short position, so the option that I sold expiring tomorrow, and the upper line shows the option that I purchased, and that expires in April, so it was more expensive than the one that I sold, and that's why this was a debit trade. And what I was hoping for is that this line over here indicates the earnings. After the earnings, the volatility always drops. And what I was hoping for is that my short position is going to lose most of its value because it will expire tomorrow, and my long position will lose only a fraction of its value. And because of that, if everything works out nicely according to your plans, then you can close both of those for a nice credit. And if that credit is larger than your debit when you open the trade, then obviously you profit. So if we go over to my trading platform, you can see that the $35 put option yesterday closed at 0.82, and today it closed at 123. So it did go up in value a little bit, and normally that would have hurt me, but because I also purchased a put option in April and it also went up in value, in fact it went up a dollar more than my other position, that's why I was able to profit. So this one yesterday closed at 449 and today it closed at 565. So if we look at, I have a little spreadsheet in here which outlines this. So yesterday, these are using the close prices. I did actually purchase this trade for 361 instead of 367, but I'm just using the close prices for simplifying the calculations and to demonstrate it to you that this is how it works. And today, these are the close prices for those expirations. And once again, it's the 135 put options on IBM. And today, that particular combination would cost $4.42. So yesterday, I paid $3.67. Today, I closed it at $4.42. And that's a 0.75 profit. Now, my profit was actually higher because I was able to close the position earlier. And if we take a look at the daily chart of IBM, then we can see that the price was going all the way down to 33. I can't remember exactly when I closed it and what was the price at the time of closing, but obviously because of that fluctuation, you can often get better deals than if you just look at the end of day prices. So that's how I was able to generate a tremendous profit on this deal. And it was a very low risk deal. I strongly recommend it for those of you who are a bit more risk averse. This is definitely a type of trade for you. Now, I did something similar today. So this is my trade number 231, and I did pretty much exactly the same on Visa. This may not actually work out because earnings already came out, and if we take a look at the daily chart, we can see that the price went up from about 224.75 to 227, so it went up $3, and it may not work out for me that well. But the good news is that I sold the January 27 put option and I purchased the April put option, so I've got plenty of time to make adjustments and turn this into a profitable trade. Now, the last thing I wanted to show you is my adjustment on my QQQ position. I rolled from my February expiration to March, and over here we can see a chart which shows the movement. So the dashed line or the dotted line shows my premium, the total premium that I collected. Normally I go up, the premium goes up, and then when I roll to the following month, I lose a bit of credit because I widen my strikes. So this time I did not make too many adjustments, so I was able to roll to March for a little bit extra credit. My strangle is not as wide as I would like it to be, given that I'm expecting the volatility to increase, but hopefully the market will stay calm for another 2-3 weeks, and then I'll be able to roll my position to April if needed and widen my strikes further. But you can see that just by keep rolling and selling a strangle against these major indices, you can bit by bit generate a nice profit, and it's another fairly safe way of trading options. So that wraps up my trade number 231. Once again, it was a calendar spread, put spread on Visa. So fingers crossed it will work out as beautifully as my trade from yesterday. So keep tuning in, keep watching my daily trade logs, and hit the like button, subscribe to my channel, and I'll see you on the next video. Thank you for watching.